Most people think of long-term and short-term rentals as versions of the same thing, a property that generates rental income, one with longer leases, one with shorter stays. The difference feels like a choice about income levels. Short-term produces more, long-term produces less, and the decision comes down to how much effort you're willing to put in for how much return. That framing misses the structural difference between the two models. They're not the same asset class operating at different income levels. They're two different businesses that happen to involve the same physical asset. The first structural difference is the cost base. A long-term rental has a predictable cost structure: mortgage, insurance, property taxes, maintenance reserves, management fees. These costs are relatively stable. They don't change dramatically month to month. They can be budgeted against with reasonable confidence. A short-term rental has a different cost base entirely: furnishing and staging, platform fees on every booking, cleaning between every stay, higher insurance requirements, ongoing restocking of consumables, more frequent maintenance from higher turnover, professional photography, dynamic pricing management. The cost base is significantly higher and significantly more variable, which means the revenue number on a short-term rental cannot be compared directly to the revenue number on a long-term rental without understanding what each of those revenues costs to produce. The second structural difference is volatility. A long-term rental produces income through a lease agreement. A tenant commits to a term. The income is contractually established. Vacancy is episodic. It happens between leases, not continuously throughout the year. A short-term rental produces income through individual bookings. No contractual commitment beyond the stay. Occupancy fluctuates with seasons, with platform algorithm changes, with local competition, with broader travel patterns. A long-term rental in a stable market produces predictable income. A short-term rental in a strong market produces variable income, high in peak periods, potentially much lower in off-peak ones. And the financial planning required for each model reflects that difference in volatility. A long-term rental can be modeled with reasonable confidence 12 months out. A short-term rental cannot. The third structural difference is the relationship to the owner's time. A long-term rental, with professional management, can be operated with minimal owner involvement. The management company handles tenant communication, maintenance coordination, lease renewals. The owner's role is oversight, not daily operation. A short-term rental is fundamentally different. Even with a co-host or property manager, the operational complexity is higher. More bookings to coordinate, more guest communication, more turnovers to manage, more issues that require immediate response because the guest is there for 3 nights and expects hotel-level responsiveness. A short-term rental is closer to running a business than to owning an asset, which is not inherently wrong, but it is structurally different from what most people imagine when they think about real estate as an investment. These structural differences, cost base, volatility, operational demand, don't make short-term rentals inferior. They make them different. And different structures produce different outcomes over time, not better or worse in absolute terms, better or worse relative to what a specific investor is actually trying to build and what they're actually willing to operate. Most people choose between these models based on the income number they see at the top, without examining the cost base underneath, without accounting for the volatility, without honestly assessing the operational commitment each requires. The income number is real. The structure underneath it is what determines the actual outcome. If this made sense to you, you already understand more than most people do. This channel exists for that kind of awareness. Like the video, subscribe, Nothing here is accidental. Short-term rentals can produce significant revenue in strong markets, in peak seasons, with the right property in the right location. The revenue numbers are real. They're compelling. They're what gets highlighted in the content, the case studies, the examples that circulate about short-term rental income. But revenue and wealth are not the same thing, and the gap between them is where most short-term rental investors discover the model didn't produce what they expected. Wealth in real estate is built through a specific set of mechanisms: equity accumulation, appreciation over time, debt paydown through consistent mortgage service, cash flow that compounds into other positions. These mechanisms work across both rental models, but they work differently because the cash flow available to compound, the debt service consistency, and the operational overhead that reduces net return are all different between the two structures. A short-term rental that produces twice the gross revenue of a long-term rental might produce a similar or lower net return after platform fees, cleaning, furnishing, insurance, management, and higher maintenance, because the cost base is proportionally higher. And a net return that looks similar on paper is not the same as a net return that behaves similarly over time. The volatility of short-term income creates a specific wealth-building problem. Compounding requires consistency. Capital that stays in a position and compounds continuously produces different outcomes than capital that arrives irregularly, high in peak months, low in off-peak ones, and needs to be managed against a cost base that doesn't fluctuate at the same rate as the income. In slow months, when bookings are down, the mortgage still comes due. The insurance still comes due. The platform fees still apply to the bookings that did arrive, which means the cash reserves that would otherwise be compounding get consumed covering the cost base during the periods when income dips. And what gets deployed into wealth building is what's left after the volatile income has covered the volatile costs. In strong markets and strong seasons, that can be significant. In weak markets or off-peak periods, it can be very little, or nothing. There's a second wealth-building problem specific to short-term rentals: regulatory risk. Short-term rental markets are subject to local regulation in a way that long-term rentals are not. Cities have restricted short-term rentals. Neighborhoods have banned them. HOAs have prohibited them. Zoning changes have eliminated what was a viable short-term market in the time between acquisition and stabilization. A long-term rental's income is not subject to the same regulatory risk. The lease structure, the tenant rights framework, the landlord-tenant law, these are stable and established. A short-term rental's income model can be legislated away without the asset itself being affected, which means the valuation, which was based on short-term income, doesn't survive the regulation, and the investor is left with an asset valued for one model that can no longer operate that model. None of this means short-term rentals don't build wealth. Some do, significantly, in the right markets, with the right properties, with the right operational approach. But the path is narrower than the revenue numbers suggest, and the investors who treat short-term rental revenue as equivalent to long-term rental wealth accumulation, without accounting for the cost base, the volatility, the operational demand, and the regulatory risk, often discover at year 5 or year 7 that the revenue was real, but the wealth position didn't develop the way the income implied it would. The 10-year financial picture of a long-term rental and a short-term rental in the same property rarely looks the way the year 1 comparison suggests. Year 1. The short-term rental often wins on revenue, sometimes significantly. Year 10. The picture is more complex, and for many investors, not what they expected when they chose the short-term model. What a long-term rental builds over 10 years: consistent debt paydown, every mortgage payment reducing the loan balance, equity building quietly, month after month, whether the market appreciates or not, stable cash flow, predictable, budgetable, available to deploy into other positions rather than held in reserve against income volatility. Market appreciation on a fully leveraged position, the equity amplified because the debt is serviced by the tenant's rent, not by the owner's capital. And a scalable model. Each long-term rental added to the portfolio operates on a similar structure. The management complexity doesn't grow exponentially with scale. 10 years of that, consistently executed, produces a compounding equity position that looks very different from where it started. What a short-term rental builds over 10 years: higher gross revenue, in years where the market cooperates. Higher operational complexity across all 10 years. Higher sensitivity to market shifts, platform algorithm changes, local competition increases, regulatory environment changes. A wealth position that depends on continued strong occupancy to sustain itself, rather than a position that compounds through structural mechanisms independent of market conditions. And a scalability challenge, because the operational complexity of short-term rentals grows more than proportionally with scale. Two properties aren't twice as complex as one. They're often 3 or 4 times as complex, because the guest-facing operational demands don't systematize as cleanly as long-term rental management does. This doesn't mean long-term is always right. Markets exist where short-term rental income is so significantly above long-term income and where the cost base is manageable relative to that income that the short-term model produces superior wealth outcomes. Those markets exist. They're real. But they're specific. They require the right property in the right location with the right regulatory environment and the right operational approach. The long-term model is more broadly applicable, more predictable, more scalable, more aligned with how real estate has historically built wealth, through equity accumulation, appreciation, and consistent cash flow over long holding periods. Most people choose between these models based on the income number. Short-term shows more at the top, so short-term gets chosen, without working through what the cost base reduces it to, without stress testing the income through a slow season, without modeling what 10 years of each structure actually produces in equity and deployable cash flow. The revenue number is compelling. The structural analysis is more complex, and most people stop before they reach the structural analysis, which is where the actual decision about which model fits a specific financial position and a specific set of goals actually gets made. If this shifted something for you, subscribe. Like this if it clarified something. Most asset classes share a basic structure. You deploy capital. The capital appreciates over time. You sell the position and realize the gain. The return comes from one mechanism: price movement. Real estate doesn't work that way. Not primarily, not structurally. Real estate operates through a different set of mechanisms, several of them running simultaneously, most of which have nothing to do with whether the market is moving up or not. The first structural difference is leverage. When you deploy capital into stocks, you deploy the capital you have. The return comes from that capital. The upside is proportional to your input. Real estate is financed differently. A relatively small capital input, a down payment, controls a significantly larger asset. The appreciation happens on the full asset value, not just on the capital deployed, which means the return on the capital deployed is disproportionate to the input in a way that pure equity investing doesn't produce. That's leverage operating in its most accessible form, not borrowed money in the abstract, a specific structural property of how real estate is financed and controlled. The second structural difference is cash flow. A stock position produces income through dividends if the company pays them. It appreciates if the market moves. But the position itself doesn't produce cash independent of market conditions. A rental property produces cash every month the tenant pays rent, independent of whether the property has appreciated, independent of whether interest rates moved, independent of broader market conditions. The income arrives from the use of the asset, not from the price of the asset. That distinction matters structurally, because cash flow is present and operational. Appreciation is future and speculative. A property that cash flows is producing return right now, regardless of what happens to its market value over the next 10 years. The third structural difference is tangibility. A stock represents ownership in a corporate entity, an intangible claim on future earnings, something that can go to zero if the company fails, or if the market decides it's worth less than it was yesterday. Real estate is a physical asset, land, structure, something that exists independent of what any market decides it's worth on a given day. The value can decline, the market can reprice it, but the asset itself remains. The land remains, the structure remains, the utility it provides remains. That tangibility creates a floor that purely intangible assets don't have. Not an absolute floor, not protection from all downside, but a structural property that changes how the position behaves during periods of market stress. These three properties, leverage, cash flow, tangibility, don't exist independently in real estate. They interact. The leverage amplifies the return from the appreciation. The cash flow services the debt that makes the leverage possible. The tangibility provides the collateral that makes the financing available. Each property reinforces the others. Each one makes the others more accessible. Which is why real estate doesn't behave like other asset classes. It's not a different version of the same compounding mechanism. It's a structurally different instrument, with a different relationship between capital input, income generation, and return. And understanding that structure clearly is the beginning of understanding whether and how it fits into a specific financial position. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. Most people think about real estate returns the same way they think about stock returns. Price goes up, you sell, you profit. And appreciation is real. It's part of the return. But it's one mechanism among several, and it's not always the most significant one over a given holding period. Real estate compounds through multiple channels simultaneously, and understanding each one separately changes how the total return is understood. The first compounding mechanism is appreciation. The property increases in value over time. The market reprices it upward. The equity position grows. This is the mechanism most people focus on, and it's meaningful, particularly because of how leverage amplifies it. A 10% appreciation on a property represents a significantly higher return on the capital deployed, because the capital deployed was a fraction of the total asset value. But appreciation is market dependent. It doesn't arrive on a schedule. It fluctuates. It can reverse. It requires the market to cooperate. The other mechanisms don't. The second mechanism is debt paydown. Every mortgage payment reduces the outstanding loan. The equity position in the property grows, not because the property appreciated, but because the debt decreased. And in a rental property, the tenant's rent payment is servicing a significant portion of that mortgage, which means someone else's payment is building equity in an asset you own. That equity growth happens every single month, independent of the market, independent of whether the property has increased in value or not. It compounds quietly, consistently, without requiring any market movement. The third mechanism is cash flow. When rent exceeds the combined costs, mortgage, taxes, insurance, maintenance, the property produces net income. That income arrives monthly. It's operational. It doesn't require the property to be sold to be realized. And that cash flow, deployed back into the position or into other positions, begins its own compounding cycle. Cash flow compounding on top of equity compounding on top of appreciation compounding. Multiple mechanisms running simultaneously, each one building on the others. The fourth mechanism is tax treatment. Real estate has a specific set of tax advantages that most other asset classes don't. Depreciation allows the owner to deduct a portion of the property's value from taxable income each year, even as the property appreciates. The mortgage interest is deductible. Capital gains on sale can be deferred through specific exchange structures. The tax treatment of rental income differs from the treatment of earned income. These aren't loopholes. They're structural features of how the tax code treats real property, features that have existed for decades because of the role real estate plays in housing supply and economic activity. And they compound. Tax advantages that reduce the drag on income allow more of the return to stay in the position, compounding forward rather than being extracted. 4 mechanisms, each one producing return through a different channel, each one running simultaneously. Appreciation, debt paydown, cash flow, tax treatment. None of them requiring all 4 to work at once to produce a meaningful return. A property that cash flows well but hasn't appreciated significantly is still producing through 3 channels. A property that has appreciated significantly but produces modest cash flow is still compounding through the others. That's what makes real estate structurally different. Not one mechanism that works well, multiple mechanisms that work simultaneously, each one reinforcing the others over a long enough holding period. Real estate has structural advantages that other asset classes don't. But it also has structural limitations that are just as important to understand. And most conversations about real estate spend a lot of time on the advantages and very little on the limitations, which produces incomplete thinking about whether and how the asset class fits into a specific financial position. The first structural limitation is liquidity. A stock position can be converted to cash in seconds. A click, a market order. The capital is accessible almost immediately. A real estate position cannot. Selling a property takes months. Finding a buyer, negotiating terms, title work, closing. The capital is locked in the asset until that process completes, which means real estate is not appropriate as a repository for capital that might need to be accessed quickly. Emergency funds, short-term reserves, capital needed within a 1 to 2 year window, these don't belong in real estate. The illiquidity of the asset class makes it structurally inappropriate for those functions. The second structural limitation is concentration. A single rental property represents a significant concentration of capital in one asset, in one location, in one market. If that local market underperforms, if the neighborhood declines, if the local economy contracts, if vacancy rates rise in that specific area, the position is fully exposed. There's no diversification benefit inside a single property, which means the early stages of real estate investing, when one or two properties represent the majority of the portfolio, carry concentration risk that larger, more diversified positions don't. That's not a reason to avoid it. It's a structural property to be aware of. And a reason why real estate works differently at scale than it does in the early stages. The third structural limitation is management. Real estate is not fully passive in the way a stock index position is. Tenants require management. Properties require maintenance. Vacancies require attention. Legal and regulatory requirements require ongoing compliance. Property management can be outsourced. The management burden can be reduced, but it cannot be eliminated entirely. There is always a layer of operational complexity that equity investments don't have, which means the return from real estate has to be measured net of that management cost, whether the cost is financial or time-based. And for someone at an early stage, with limited time already compressed by a primary income and secondary stream development, that operational layer is a real cost. None of this makes real estate a poor asset class. The structural advantages are genuine. The compounding mechanisms are real. The leverage, cash flow, tax treatment, these are meaningful structural properties that other asset classes don't replicate. But the structural limitations are equally real. Illiquidity, concentration, operational complexity. And a clear understanding of both sides, the advantages and the limitations, is what allows someone to determine whether real estate belongs in their position, at what stage, at what scale, and in what combination with other instruments. The asset class doesn't have universal answers. It has structural properties, and structural properties interact differently with different financial positions. Understanding them clearly is what makes the decision informed rather than ideological. If this shifted something for you, subscribe. Like this if it clarified something. When a first real estate investment fails, the explanation that gets offered is almost always about timing. The market turned. The interest rates moved. The tenant was bad. The neighborhood changed. These things happen. They're real. They affect outcomes. But they're rarely the primary cause of a first-time failure. The primary causes almost always appear before the acquisition closes, in the underwriting, in the assumptions, in the steps that got skipped because the deal felt right and the process felt like a formality. The first structural failure point is the pro forma. Not the market, not the tenant, the numbers that were built before the deal was done. First-time investors build pro formas from the information the seller provides, the current rent roll, the expense history, the occupancy data. And those numbers, presented by someone motivated to sell, reflect the best version of what the property has produced. Not the realistic version, not the stressed version, the version that makes the deal look attractive. Vacancy at the lowest it's been, expenses at the lowest they've run, rent at the top of what the market supports. And the investor, new to the process, builds their analysis on those numbers, without independently verifying them, without stress testing them, without asking what happens if even one of them is wrong. The second structural failure point is the physical condition of the asset. A standard inspection identifies what's currently wrong. It doesn't identify what's about to go wrong. The roof with 3 years of usable life, the HVAC system on borrowed time, the plumbing that passes inspection but will fail within the ownership period. First-time investors treat the inspection as the end of the physical evaluation. Experienced investors treat it as the beginning. They bring specialists, a roofing contractor, an HVAC technician, a plumber, not to find reasons to walk away, but to build an accurate picture of the capital expenditure timeline the asset is going to require, and to price that into the deal, or negotiate accordingly before the acquisition closes. The third structural failure point is the market assumption. Most first-time investors underwrite to current market conditions, current rents, current vacancy rates, current comparable sales, as if those conditions will persist through the holding period. Markets move. Rent growth assumptions that seemed conservative can prove optimistic if local employment shifts or new supply enters the submarket. Vacancy assumptions built on peak occupancy can prove wrong in the first year of ownership if the tenant mix changes or a larger competing property opens nearby. The investor who underwrites to current conditions without examining the direction of those conditions, who doesn't ask whether rents are at the top or bottom of a local cycle, is underwriting a static version of a dynamic reality. These 3 failure points, optimistic pro forma, incomplete physical evaluation, static market assumption, are structural. They're not bad luck. They're not timing. They're the result of a process that was abbreviated, that trusted seller-provided information, that treated inspection as sufficient, that assumed current conditions would persist. And they're visible in hindsight, almost universally, as things that could have been identified before the acquisition closed. Not always in time to change the decision, but in time to change the terms, to negotiate a lower price, to build a larger reserve, to structure the deal differently. The market didn't cause the failure. The process that missed what was already there caused the failure. And the market just made it visible. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video, subscribe. More clarity is coming. The most expensive mistakes in real estate aren't analytical errors. They're emotional decisions dressed up as analysis. They follow predictable patterns. They feel like logic from the inside. They look like something else entirely from the outside. And they almost always appear at a specific point in the process, after the investor has decided they want the deal and before the due diligence is complete. The first emotional pattern is anchoring to the vision. A first-time investor visits a property. They walk through it. They start to see what it could be, not what it is. The renovated version, the full occupancy version, the version where everything the seller implied turns out to be accurate. And from that moment, the analysis shifts. It's no longer an objective evaluation of whether this specific deal produces an acceptable return under realistic assumptions. It's a search for confirmation that the vision is achievable. Numbers that support the vision get accepted. Numbers that challenge it get explained away. Concerns that arise during due diligence get minimized because the vision has already been built and the analysis is now working in service of the decision rather than informing it. The second emotional pattern is loss aversion at the wrong moment. A deal has been under contract for weeks. Due diligence has been ongoing. Time has been invested. Deposits have been made. And then something comes up. a structural issue, a discrepancy in the numbers, a problem the inspection revealed that changes the economics. And instead of renegotiating or walking away, the investor absorbs the new information and continues anyway. Not because the deal still makes sense, because walking away feels like losing everything that's been invested in the process. The time, the energy, the professional relationships engaged, the mental commitment to the outcome. Loss aversion, the behavioral tendency to feel losses more acutely than equivalent gains, keeps people in deals that the numbers have already told them to exit. The third emotional pattern is social validation pressure. Real estate decisions rarely happen in isolation. Advisors are involved, agents are involved, family members have opinions, friends have been told about the deal. And the investor, who started the process as the decision maker, gradually becomes the person managing everyone else's expectations about what they're going to do. Walking away from a deal that everyone knew about, that was discussed at dinner, that the agent has been working on for weeks, feels different from walking away from a private decision. The social context creates pressure to follow through, not because the deal is right, but because reversing course feels like explaining a failure to people who were watching. These patterns aren't unique to real estate. They're how human decision-making works under conditions of commitment and visibility. But in real estate, where the stakes are high, the transactions are slow, and the commitment builds gradually, the emotional patterns have particularly significant consequences. The deal that gets done because the investor was anchored to a vision, because walking away felt like losing, because everyone was watching, is the deal that performs worst. Not because the market failed, because the decision-making process was captured by the wrong inputs before the acquisition closed. Due diligence is the part of the process most first-time investors treat as a formality. The deal has been found, the price has been negotiated, the contract has been signed. Due diligence feels like the administrative phase, the steps that confirm what the investor already believes to be true before moving to closing. That framing is wrong, and the cost of it is visible in the outcomes of first-time investments more clearly than anywhere else. Rigorous due diligence is an independent investigation, not a confirmation of the seller's narrative, not a search for reasons to feel comfortable about a decision already made. An independent investigation into whether the asset is what it appears to be, and whether the deal produces what the analysis assumes. That means verifying every number the seller has provided. Rent rolls, verified against actual lease agreements. Expense history, verified against actual invoices, not summaries, invoices. Occupancy history, verified against actual booking records. Tax and insurance costs, verified against actual bills. Not because sellers lie, because sellers present the best version, and the best version is not the same as the operating reality. Physical due diligence goes further than the standard inspection. The general inspection identifies what's currently wrong. Rigorous physical due diligence identifies what's currently wrong and what the capital expenditure timeline looks like for the next 5 to 10 years. Specialty contractors assess the roof, the HVAC, the plumbing, the electrical, not to kill the deal, but to build an accurate capital expenditure model, so that the reserve requirement is sized correctly, so that the cash flow assumption accounts for the capital expenditures that the asset will require, not the ones that appeared in the last year's expenses. Because assets don't require capital expenditures on a convenient schedule. They require them on a physical schedule, determined by the age and condition of the systems, regardless of what the previous owner chose to budget for. Market due diligence examines the direction of conditions, not just the current state. What is the supply pipeline in this submarket? New apartments being permitted, new competition being built, developments that will come online within the next 2 to 3 years and affect occupancy and rental rates. What is the employment base? Is the local economy diversifying or concentrating? Are the major employers in the area expanding or contracting? What is the regulatory environment? Are there rent control discussions in this jurisdiction? Short-term rental restrictions? Zoning changes pending that would affect the asset's use or value? None of this is visible from the listing. All of it is discoverable with the right research in the right time frame before the acquisition closes. The investors who perform rigorous due diligence don't kill more deals than those who don't. They make different decisions about the same deals. Some deals that would have closed don't close because the due diligence revealed something that changed the economics. Some deals close at lower prices because the due diligence revealed a negotiating position that the seller's narrative had obscured. Some deals close as planned because the due diligence confirmed that the asset is what it appeared to be. The process produces information, and information, used correctly, produces better decisions than confidence in a narrative does. The first-time investor who treats due diligence as a confirmation step is missing the entire point of it. It's not there to confirm. It's there to reveal. And what it reveals before the acquisition closes is the only thing that can actually change the outcome that follows. If this shifted something for you, subscribe. Like this if it clarified something. Most people looking at a real estate deal start with the same number, the price. And from the price, they move to the rent. How much does it rent for? Does the rent cover the mortgage? Is there something left over? That's the analysis. For most people, that's where the evaluation begins and ends. And that approach, as intuitive as it feels, misses most of what actually determines whether a deal works. The first number most investors encounter is the cap rate, capitalization rate, the ratio of net operating income to the property's purchase price. A 5 cap, a 7 cap, a 10 cap. These numbers get referenced in listings, in conversations, in analysis, as if they're the primary signal of whether a deal makes sense. And they contain real information. A cap rate reflects the return on a property purchased with all cash, no financing, relative to what the property produces. But almost nobody buys with all cash, which means the cap rate is answering a question most buyers aren't actually asking. The cap rate tells you what the property produces as a percentage of its value, without any reference to how the acquisition was actually financed. And financing is where the actual returns get determined. The second number most people reach for is gross rent. The listing says it rents for X per month. The mortgage payment is Y. X minus Y looks positive. That's the deal. That's the analysis. Except gross rent is not what the property actually produces. Gross rent is the income before every cost that matters. Before vacancy, before property management, before insurance, before taxes, before maintenance and repairs, before capital expenditures, the roof, the HVAC, the water heater that will eventually need replacing. Strip all of that out, and what remains is net operating income. And net operating income is the number that actually matters. Not gross rent, not the number on the listing, not the number that makes the deal look attractive before the real costs are accounted for. The third surface metric is the listing price itself. Most people evaluate a deal relative to what the seller is asking. Is this a good price for this property? Is it below market? Is it fairly valued? These are real questions, but they're questions about the asset's price relative to comparable assets, not about what the asset actually produces relative to what it costs to hold. A property priced below market can still be a poor investment if the income it generates doesn't support the cost of ownership. And a property priced at or above market can still be a strong investment if the cash flow and return metrics justify the acquisition cost. Price is context, not conclusion. These surface metrics, cap rate, gross rent, listing price, are where most people stop. Not because they're unintelligent, not because they're not trying, because these are the numbers that are visible immediately, the numbers on the listing, the numbers referenced in the first conversation, the numbers that feel like analysis because they involve math. But they're the beginning of the question, not the answer. The answer lives in a different set of numbers, numbers that require more work to assemble, numbers that don't appear on listings, numbers that only emerge from a more complete picture of what the deal actually produces after every real cost is accounted for. Once the surface metrics are set aside, once the cap rate and the gross rent are recognized as starting points rather than conclusions, the real analysis begins. And it begins with one number: net operating income. Net operating income, NOI, is what the property actually produces before debt service. Gross rent, minus vacancy allowance, minus property management, minus insurance, minus property taxes, minus maintenance reserves, minus capital expenditure reserves, equals net operating income. This is the number that reflects what the property generates from its operations, independent of how it was financed. And it's the number from which everything else is built, because it's what's actually left after the real costs of running the property are accounted for. From net operating income, the next critical metric emerges: debt service coverage ratio, DSCR. The ratio of net operating income to the annual mortgage payment. A ratio above 1 means the property generates more than it costs to service the debt. A ratio below 1 means the property doesn't produce enough to cover its own financing, which means the owner is subsidizing the property out of pocket every month. A ratio at exactly 1 means the property breaks even on debt service, with nothing left for unexpected costs, vacancy, or return on equity. Lenders use this metric because it tells them whether the income supports the loan. Investors should use it because it tells them whether the deal actually works under real operating conditions. The third critical metric is cash-on-cash return. This answers the question that cap rate doesn't. Not what does the property produce as a percentage of its total value, but what does it produce as a percentage of the actual cash deployed? The down payment, the closing costs, the initial repairs or improvements, the total capital actually committed. Cash-on-cash return measures what that deployed capital is actually returning annually after all operating costs and debt service are paid. This is the number that makes different deals comparable, because two properties at the same price in the same market can produce dramatically different cash-on-cash returns depending on how they're structured, how they're financed, and what they actually cost to operate. These three metrics together, net operating income, debt service coverage ratio, cash-on-cash return, tell a different story than the surface numbers do. They tell the story of what the deal actually produces, not what it costs to buy, not what it rents for on the listing, not what the cap rate implies under conditions that don't apply. What it produces after every real cost, after the financing, after the operating reality, as a return on the capital actually committed. That's the analysis. Not one number, three, each one answering a question the others don't, and together, producing a picture of the deal that the surface metrics never could. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. A deal can look clean on paper and still fail in reality. Not because the numbers were wrong, because the numbers were incomplete. Pro forma analysis, the projected income and expense statement built before the acquisition, is inherently optimistic. It reflects assumptions about occupancy, about rental rates, about operating costs, about the condition of the asset. And assumptions, by their nature, represent the version of reality the analyst hopes will materialize, not the version that always does. The first gap between pro forma and reality is vacancy. Most pro formas assume the property will be occupied at or near full capacity. A 5% vacancy allowance, maybe 10% in more honest projections. But real vacancy is unpredictable. Markets shift, tenants leave, turnovers take longer than expected, bad tenants stay longer than desired. And the vacancy that actually occurs, especially in the first few years of ownership, is rarely what the pro forma assumed. Which means the income the deal was underwritten on is rarely what the deal actually produces in the early operating period. The second gap is deferred maintenance. A property inspected before acquisition reveals what's currently wrong. It doesn't reveal what's about to go wrong. The roof with 3 years of life left, the HVAC system running on borrowed time, the plumbing that works today but will require significant attention within the first ownership period. These costs don't appear on the pro forma. They appear in year 2, in year 3, in the capital expenditure budget that the deal analysis didn't adequately account for. And when they arrive, they compress or eliminate the cash flow the deal was projected to produce. Not because the analysis was fraudulent, because deferred maintenance is structurally difficult to underwrite before it becomes an active problem. The third gap is the cost of capital. Most deal analysis uses the financing terms available at the time of underwriting, a specific interest rate, a specific loan structure, a specific set of terms that reflect the lending environment at the moment the deal is modeled. But financing terms change, rates move, lending standards shift. Refinancing, which many deals depend on for their return profile, happens in a different rate environment than the one the deal was originally structured in. And the deal that worked at the original rate may work very differently when refinanced at a higher one. The cost of capital is a variable, not a constant, and pro formas that treat it as fixed are underwriting a version of the deal that may not survive contact with the actual market. This isn't an argument against real estate analysis. It's an argument for more complete analysis. Stress testing the numbers, not just what happens if everything goes right, but what happens if vacancy runs higher, if a capital expenditure arrives early, if rates move against the refinance. A deal that works under optimistic assumptions is a deal that might work. A deal that still works under stressed assumptions, with higher vacancy, with unplanned capital costs, with a different rate environment, is a deal that probably works. The difference between those two is the gap between what the numbers show and what the deal actually produces. And most people never look past the first version. Real deal analysis isn't one number. It isn't the cap rate. It isn't a gut feeling about the neighborhood. It isn't a comparison to what similar properties sold for. It's a layered process. each layer revealing something the previous one didn't, each metric answering a question the others leave open. And the process ends not with certainty, but with a position. The first layer is the surface read: price, gross rent, cap rate, the numbers on the listing. These tell you whether the deal is worth spending more time on, whether the ratio of income to price is in a range that makes further analysis worthwhile. They're filters, not conclusions. If the surface numbers are completely out of range, if the gross rent doesn't come close to supporting the acquisition cost, the analysis stops here. If they're in range, the analysis continues. The second layer is the real income picture. Gross rent broken down into net operating income. Every operating cost accounted for. Vacancy allowance built in at a realistic rate, not an optimistic one. Management fees, insurance, property taxes, maintenance reserves, capital expenditure reserves. What remains after all of it is the actual income the property produces, not what the listing implies, what the operations actually generate. The third layer is the financing picture. Debt service coverage ratio, cash-on-cash return. What the deal produces relative to the capital actually committed. And stress-tested, not just at the best-case assumptions, but at higher vacancy, at unexpected capital costs, at a refinance rate that's moved against the position. Does the deal still work if two of those things happen simultaneously? If yes, the deal is structurally sound. If no, the deal depends on things going right. And things going right is not a thesis. It's hope. The fourth layer is the exit picture. How does the deal end? A sale in 10 years at a projected appreciation rate? A refinance to pull equity and redeploy it? A hold indefinitely for the cash flow? Each exit path has different return implications, different tax implications, different requirements for what the deal needs to produce in the interim. And the exit picture changes what the right entry looks like. A deal held for cash flow can be evaluated primarily on cash-on-cash return. A deal held for appreciation and refinance needs to be evaluated on equity growth and the rate environment it will refinance into. Different exits require different underwriting, and the analysis isn't complete until the exit is part of the picture. The full picture, surface metrics, real income, financing stress test, exit path, is what real deal analysis looks like. Not a single number, not a feeling, not a comparison to what someone else paid. A layered process that ends with a position, a clear view of what the deal actually produces, under what conditions, and whether those conditions are reasonable to expect. Most people never build the full picture. They stop at the layer that confirms what they already wanted to do. And the deals that look right but perform wrong are almost always the ones where the analysis stopped too early. If this shifted something for you, subscribe. Like this if it clarified something. Most people who want to invest in real estate believe they're waiting for one thing: enough capital. Enough saved for the down payment. Enough reserves to cover the unexpected costs. Enough of a financial cushion to make the risk feel manageable. And so they wait, saving toward a threshold, watching the market, telling themselves the move will happen when the capital position is strong enough. The threshold keeps moving. The market keeps changing. The capital never feels quite enough. And the entry never happens. The capital myth has a specific structure. It takes the most capital-intensive version of real estate entry, a conventional acquisition, 20% down, full reserves, no creative structure, and presents it as the only version, which makes the capital requirement feel fixed, significant, a hard threshold that must be cleared before entry is possible. And for someone watching that threshold from a position of building capital slowly, the entry feels permanently deferred. Not impossible, just always slightly out of reach. Which produces the same result as impossible. The entry doesn't happen. The position never gets started. The compounding clock never starts. The myth is compounded by how real estate gets discussed publicly. The deals that get attention, the transactions that get documented, the success stories that get shared, are almost always the ones that involved significant capital. Large down payments, full cash purchases, portfolios built from a position of substantial initial capital. These are real, they happen, but they represent one entry path among several, and the visibility of the capital-intensive path makes the other paths feel like exceptions, things that work for other people in different circumstances, rather than legitimate structures available to anyone with the right knowledge and positioning. The perception problem matters because it shapes behavior before any actual barrier is encountered. Most people never reach the point of seriously evaluating a deal, of running real numbers, of exploring actual financing structures, because the capital myth has already told them they're not ready. Not yet. Not until the savings are larger. Not until the position is stronger. And so the preparation that would actually move them toward entry, the underwriting knowledge, the market understanding, the network of people who transact in this space, never gets built. Because the capital myth convinced them to wait for something that would make starting feel safe, rather than building the things that would make starting possible. Capital is necessary, at some point, in some form, but it is rarely the first barrier. The first barriers are knowledge and positioning, understanding how deals work, understanding how they're financed, understanding what makes a deal attractive to the people who have capital and are looking for the right opportunities. Most people who successfully enter real estate without significant initial capital didn't get there by saving longer. They got there by removing the other barriers first: the knowledge gaps, the underwriting ability, the network, the positioning, until capital became the last barrier. And then finding ways to address that last barrier creatively. The capital myth keeps people working on the last barrier first, while the real barriers remain unaddressed, and the entry stays deferred. If capital isn't the primary barrier, what is? The honest answer is that most people who don't enter real estate don't lack capital as their primary obstacle. They lack the knowledge to evaluate a deal, the network to find deals worth evaluating, the underwriting skill to know what a deal is worth, the risk tolerance that comes from understanding what can go wrong and how to manage it. These are the real barriers, and they're addressed differently than a capital shortfall is. Knowledge is the first real barrier. Real estate transactions are complex. Legal structures, financing arrangements, title and ownership mechanics, lease structures, market analysis, property condition assessment. Most people approaching real estate for the first time don't understand these mechanics well enough to evaluate whether a specific deal makes sense in a specific context. And without that understanding, every deal feels risky in a way that's hard to quantify. Not because every deal is bad, because the tools to evaluate which deals are bad haven't been developed yet. That knowledge gap, not the capital gap, is what keeps most people in the evaluation phase indefinitely. Deal flow is the second real barrier. Most people looking for real estate deals look in the same places as everyone else: public listings, online marketplaces, properties that have been marketed broadly and are therefore priced to reflect the full competitive market. The deals that get done at the most favorable terms, the off-market transactions, the motivated seller situations, the properties that haven't been broadly marketed, come through networks, through relationships, through being positioned as someone who can execute when an opportunity appears. Most people don't have that positioning, not because it's inaccessible, because building it requires time and intentionality, showing up in the right spaces, developing relationships with people who transact, building a reputation for being able to move. And most people are waiting to build that network until after they have the capital, when, in reality, the network often precedes the capital, and sometimes replaces it. Underwriting skill is the third real barrier. Underwriting is the ability to look at a deal, a specific property, in a specific market, at a specific price, and determine what it's actually worth under realistic operating assumptions. Not what the seller says it's worth, not what the listing implies, what the income, expenses, financing, and exit combine to produce as a return on invested capital. This skill takes time to develop. It requires analyzing deals, many deals that never get purchased, building the pattern recognition to see quickly what the numbers are likely to show before spending hours building the full analysis. Most people haven't done that work because they believe the work starts after they have the capital, when, in reality, the work that produces the capital starts long before the capital arrives. The real barriers compound each other. Without knowledge, deals feel uniformly risky. Without deal flow, only the worst opportunities are visible. Without underwriting skill, there's no way to separate the good deals from the bad ones. And without all three, capital alone doesn't produce a successful entry. It just produces an expensive mistake made with more money. The people who enter real estate effectively, regardless of their initial capital position, addressed these barriers first. They built the knowledge, they developed the network, they learned to underwrite. And then, they found ways to address the capital barrier, often discovering that the other barriers being cleared made the capital barrier significantly smaller than it appeared from the outside. Most content talks at you. This one sits with you. If that difference stood out, if this felt real instead of loud, like the video, subscribe. This channel is built for people who notice patterns. Real estate transactions don't always look the way most people imagine. The standard mental model is straightforward. Buyer has capital, buyer makes down payment, bank provides mortgage, transaction closes. That model is real. It's common. It's how many transactions happen. But it's one structure among many, and most people are only aware of that one. The first alternative structure is seller financing. In a seller-financed transaction, the seller acts as the lender. The buyer makes payments directly to the seller rather than to a bank. The terms are negotiated between the parties. The down payment requirement can be significantly lower than conventional financing demands. The qualification standards are determined by the seller, not by a bank's underwriting criteria. Seller financing exists because sellers sometimes have motivations that make a conventional sale less attractive than a structured payment arrangement. Tax deferral on a large gain, steady income from the interest payments, a faster transaction without bank timelines and requirements. These motivations create opportunities for buyers who understand the structure and know how to present it. The second alternative structure is partnerships. Real estate partnerships allow the skills and the capital to come from different people. One party brings the deal, the underwriting, the market knowledge, the ability to find, evaluate, and manage the asset. Another party brings the capital, the down payment, the reserves, the financial position required for the financing. Each party contributes something the other needs. Each party receives a portion of the return commensurate with their contribution. This structure exists because knowledge and capital are not always in the same hands, and when they can be brought together, both parties can access a deal neither could have executed alone. The third alternative structure is creative acquisition, subject to transactions, lease options, master lease arrangements, wraparound financing. Each of these represents a different way of controlling or acquiring a property without a conventional cash purchase. Subject to transactions allow a buyer to take over an existing mortgage, acquiring the property without new financing. Lease options allow control of a property and the right to purchase at a future date, without immediate acquisition. Master lease arrangements allow management and income rights without full ownership, as a step toward eventual acquisition. These structures are more complex. They require deeper knowledge to execute. They involve legal and financial nuances that conventional transactions don't. But they exist. They're used regularly by investors who understand them. And they represent entry points into real estate that don't require the capital that conventional acquisition does. None of these alternatives are without risk or complexity. Seller financing requires a motivated seller. Partnerships require aligned incentives and clearly structured agreements. Creative acquisition requires legal competence and thorough due diligence. But the complexity of these structures is addressed through knowledge, not through capital. And knowledge is the barrier that can be removed before the capital exists. The investors who transact through these alternative structures are not doing something unusual. They're using tools that have existed for decades, that are standard practice in sophisticated real estate markets, that most people never explore because they believe the conventional structure is the only one available. The investors who access real estate deals without full capital positions didn't get there by waiting. They got there by becoming valuable before they had the capital. And that distinction between waiting for capital and building value toward capital is the core of what separates the people who enter from the people who stay on the outside. Positioning precedes capital. Not always, not in every case, but in the cases where capital isn't the starting point, where deals get done through partnerships, through creative structures, through relationships, the capital comes to the person who has made themselves valuable to people who have it. The person who can find deals, who can underwrite them accurately, who can manage the asset effectively once acquired, who can bring something to the transaction that the capital alone cannot provide. That person doesn't need to wait for the capital to be theirs. They need to build the capability that makes other people's capital available to them. What does that positioning look like in practice? It looks like learning to underwrite before having anything to underwrite, analyzing deals that will never be purchased, building the skill, developing the pattern recognition, understanding what good deals look like compared to bad ones. Until the underwriting becomes credible to other investors, to potential partners, to the people in the space who are looking for someone who can do this reliably. It looks like building the network before needing it, showing up where real estate investors show up, developing relationships with people who transact, being useful before asking for anything, building a reputation as someone who understands the space and can be trusted to execute. It looks like doing the work that most people believe only starts after the capital arrives. Because the work that produces entry is not the work of saving. It's the work of becoming someone who belongs in the room, who understands the deals, who knows the market, who has the network, who can execute. And that person, built through preparation rather than waiting, finds the capital question resolves differently than it does for someone who showed up with capital but nothing else. Capital without positioning produces expensive mistakes. Positioning without capital produces creative solutions. The person with deep knowledge and strong underwriting and a real network is fundable. Not always, not instantly, but fundable in a way that the person waiting to save a larger down payment is not. Because the real estate market doesn't just reward capital. It rewards the ability to find value, underwrite accurately, and execute reliably. Capital is the input. That ability is what makes the capital productive. And the people who develop the ability first, who position themselves as someone who can make capital work, find that capital has a way of finding them, before they expected it, and in forms they didn't anticipate. If this shifted something for you, subscribe. Like this if it clarified something. Most people's relationship with leverage is shaped by how they first encountered debt. Consumer debt, credit cards, car loans, financing things that depreciate or produce no return. And from that experience, debt becomes associated with risk, with overextension, with financial instability, which makes leverage in real estate feel like a dangerous version of the same thing. It isn't. Not because debt in real estate is risk-free, but because the structure is fundamentally different, and the risk profile that comes with it is fundamentally different. Leverage in real estate is a specific structural mechanism. A relatively small capital input, the down payment, controls a significantly larger asset. The return, appreciation, debt paydown, cash flow, happens on the full asset value, not just on the capital deployed, which means the return on the capital deployed is amplified relative to what a cash purchase would produce. That amplification is leverage, not borrowing to speculate, not financing a depreciating asset. A structural arrangement where a smaller capital input controls a larger productive asset and earns returns on the full value of that asset. The distinction matters because the return math is completely different. A cash purchase of a property earns returns only on the capital deployed. If a property appreciates 10% and you paid cash, you earned 10% on your capital. If the same property appreciates 10% and you put 20% down, you earned 50% on your capital, because the 10% appreciation happened on the full value of the asset, while only 20% of that value was your capital. The leverage amplified the return on capital by a factor of 5, not through speculation, through the structural mechanics of how the financing interacts with the asset's performance. This amplification works in reverse, too. If the property declines 10%, the leveraged investor loses 50% of their capital. The cash investor loses 10%, which is where the risk conversation usually ends. And it's true, leverage amplifies losses as well as gains. But the conversation that stops there misses the more important question. Under what conditions does a leveraged real estate position actually produce a loss on capital? Not a decline in property value, which is a paper loss on an asset that is still producing income, but an actual loss of capital. An actual loss of capital in leveraged real estate requires a specific combination of events. The property loses value significantly, and the cash flow is insufficient to service the debt, and the investor is forced to sell into the depressed market. All three simultaneously. Remove any one of those conditions, and the leveraged position can survive a significant decline in property value without a permanent loss of capital. A property that has declined in value but still cash flows adequately to service the debt doesn't require a sale. The investor holds the position. The debt continues to be serviced. The property continues to produce income. And when the market recovers, as real estate markets in structurally sound locations have historically done, the paper loss reverses. The risk of leverage isn't uniform. It's specific. It's manageable. And understanding its actual structure is what changes how it gets evaluated. The risk of leverage in real estate is not what most people imagine it to be. Most people imagine leverage risk as prices fall, you lose money. The more leverage you used, the more you lose. That's a partial picture, and a partial picture produces incomplete decisions. The actual risk structure of leverage in real estate is more specific and more manageable than the general fear of it suggests. The primary risk of leverage is cash flow failure, not price decline, cash flow failure. The leveraged position works as long as the income from the asset is sufficient to service the debt. The tenant pays rent. The rent covers the mortgage, taxes, insurance, maintenance. Something is left over as net income. As long as that structure holds, a decline in property value is a paper loss on an asset that is still working, still generating income, still paying down the debt, still building equity through debt reduction even as the market price has moved lower. The leverage isn't dangerous in that scenario. It's just carrying a position through a period of market weakness. The leverage becomes dangerous when the cash flow fails, when vacancies are extended and the mortgage still comes due, when rental rates in the market fall below the cost of servicing the debt, when carrying costs exceed income for long enough to exhaust reserves. These are the conditions under which leverage becomes a genuine risk, not price decline alone. Cash flow failure combined with an inability to service the debt from reserves or other income. Which means the risk management for a leveraged real estate position is primarily about cash flow and reserves, not primarily about predicting market direction. A position underwritten conservatively with realistic vacancy assumptions, adequate reserves, and a debt service coverage ratio that provides meaningful cushion carries a very different risk profile than a position underwritten aggressively with optimistic assumptions and minimal reserves. The second dimension of leverage risk is forced sale risk. A leveraged position that has declined in value only produces a permanent loss if the investor is forced to sell into the depressed market. Forced sales happen for specific reasons: cash flow failure that exhausts reserves, personal financial crisis that requires liquidity, loan terms that force refinancing in an unfavorable environment. A leveraged position that can be held, that cash flows adequately, that has the reserves to absorb disruption, doesn't have to be sold into weakness. It can be held through the cycle, and real estate markets in structurally sound locations have historically recovered from cyclical declines. The investor who understood the actual risk structure going in, who sized the position correctly, underwrote conservatively, maintained adequate reserves, holds through the weakness, and the paper loss becomes a temporary mark-to-market event rather than a permanent loss of capital. This is why the question isn't whether to use leverage, but whether the specific leveraged position is structured to survive the conditions under which leverage fails. Cash flow adequate to service the debt under realistic occupancy assumptions? Reserves sufficient to absorb an extended vacancy or an unexpected capital expenditure? Debt terms that don't force a refinancing at an unfavorable time? A leveraged position that answers yes to all three is a position where the risk is understood, structured, manageable. Not eliminated, managed. And managed risk produces different outcomes than avoided risk does, especially in an asset class where the return amplification of leverage compounds significantly over time. Before this continues, if you felt seen instead of sold to, that's the entire point of Relentless Wealth. Like the video, subscribe. We're just getting started. Paying cash for real estate is commonly understood as the conservative move. No debt, no mortgage payment to worry about, no leverage risk, full ownership from day one. And there is something genuinely conservative about it. The financing risk is eliminated. The cash flow doesn't need to service debt. A market decline doesn't threaten the position through forced refinancing or debt service failure. But conservative doesn't mean lower risk overall. It means the risk has been shifted, not eliminated. A cash purchase creates concentration risk. When a significant amount of capital is deployed into a single asset, all of it, without the amplification of leverage, the entire capital position is exposed to the performance of that one asset. If the property performs well, the capital performs well. If the local market underperforms, if the neighborhood declines, if the property has structural issues, if vacancy rates in that specific submarket rise, the entire capital position absorbs that underperformance fully, without the buffer of leverage that would have allowed the same capital to control multiple assets in multiple locations. The same capital that pays cash for one property could, with leverage, control 2 or 3 properties, each one in a different submarket, each one with different tenant profiles, each one producing income and building equity separately. The diversification that leverage enables is a form of risk management that the cash purchase forfeits, not because debt is inherently better, because concentration is inherently riskier than distribution across multiple positions. And the investor who paid cash, believing they were being conservative, has actually concentrated their risk more than the investor who used leverage to spread the same capital across multiple positions. The second cost of the cash purchase is opportunity cost. Capital deployed in a cash purchase is fully committed to that asset. It can't be deployed elsewhere without selling the asset. A leveraged purchase commits only the down payment. The remaining capital stays available to be deployed into other positions, into other assets, into the next opportunity that presents itself. The cash investor is fully deployed in one position. The leveraged investor is deployed in a position with capital remaining to compound elsewhere. Over time, the compound return on the deployed capital and the capital that remained available to deploy can significantly exceed the return on the fully committed cash position. None of this means leverage is always right. A cash purchase makes sense when the position is structured correctly, when the income from the asset doesn't need to service debt, when the investor's overall portfolio is already diversified, when the capital committed isn't the investor's only resource. But calling a cash purchase conservative without examining the concentration risk and the opportunity cost is an incomplete analysis. Conservative relative to financing risk, yes. Conservative overall, not necessarily. The risk doesn't disappear with the mortgage, it shifts, and the shifted risk, concentration, and opportunity cost is just as real as the financing risk it replaced. Understanding both sides is what produces an informed decision rather than a reflexively cautious one. The way leverage scales a real estate portfolio is not intuitive. Most people think about scaling linearly. Save more capital. Buy another property. Save more. Buy another. One property at a time, each one requiring the full capital input before the next can begin. Leverage doesn't work that way. It scales differently. And the compounding that results from that different scaling mechanism is one of the primary reasons real estate has historically been one of the most effective wealth-building vehicles available to non-institutional investors. The basic scaling mechanism works like this. Capital is deployed as a down payment. The leverage controls a larger asset. The asset produces income, builds equity through debt paydown, and appreciates over time. As equity builds through appreciation and debt reduction, that equity can be accessed through refinancing, not a sale, a refinance. The property stays, the income stays. The equity that has built is extracted as capital and deployed into the next position, which produces income, builds equity, appreciates, and eventually gets refinanced to fund the next position. Each asset funding the acquisition of the next without requiring the investor to generate new capital from income or to liquidate existing positions. This is the mechanism most people who have built significant real estate portfolios have used. Not saving for each down payment from earned income, using the equity that existing positions build through appreciation and debt paydown to fund the next acquisition. The portfolio compounds on itself, each position contributing to the next, the leverage amplifying the equity growth that funds the expansion. Without selling anything, without liquidating what's been built, without requiring the investor's earned income to fund each new position. The assets fund each other, over time, through the mechanics of leverage, equity accumulation, and strategic refinancing. This scaling mechanism has specific requirements. The positions have to be underwritten correctly. Cash flow has to be adequate to service the debt and maintain reserves. The refinancing has to be done at the right point in the cycle, not under pressure, not forced by market conditions. And the investor has to understand the mechanics well enough to execute the strategy over a long enough time horizon. 5 years, 10 years. The compounding that leverage produces in real estate is not a short-term phenomenon. It's a long-term structural process that requires patience, correct underwriting, conservative cash flow management, and a clear understanding of how each refinancing decision affects the overall portfolio trajectory. Most people never access this scaling mechanism, not because it's unavailable to them, because the misunderstanding of leverage, the association with dangerous debt, with speculation, with financial overextension, keeps them in a cash-only framework. A framework that is safer in a narrow sense, no financing risk, but slower, more capital-intensive, and less aligned with how real estate actually compounds at scale. Understanding leverage correctly, not as debt to fear, but as a structural mechanism that amplifies returns and enables portfolio growth, is the difference between building a real estate position slowly, one cash purchase at a time, and building one that compounds on itself, each asset funding the next, over a time horizon that eventually produces outcomes cash purchases alone could never reach. If this shifted something for you, subscribe. Like this if it clarified something.